So this video is for GCSE and Level 2 Enterprise, and it's looking at balance sheets, and it's considering three of the key components of a balance sheet. It's looking at assets, it's looking at liabilities, and it's looking at equity. And what we're going to do within this video is we're going to look at how a balance sheet is calculated and some of the key formulas that are involved. So for example, the current ratio and the liquid capital ratio, also known as the acid test. So to begin with, when we're considering an asset is simply an item of property owned by a company, and the asset has a value and it can be sold. When it's sold to be converted into cash, which then can be used to pay off any debts or financial obligations by the business. Now, the assets can be categorised into current assets and fixed assets, also known as non-current assets. So, a current asset is a short-term asset, and what I mean by that is it's expected to be converted into cash in the very near future. So, a great example of this, if you think about a company, obviously they are designed to sell goods or services. If they've got stock to sell, then that stock would be a current asset. And the reason being is because obviously when a company gets stock delivered, their whole aim is to try and sell that and turn that into revenue as fast as possible. And once that revenue is generated, then again, that's the cash that they can use to then pay off their liabilities. So stock is a key example, but there are other examples as well. If the company just simply holds cash, that cash is still seen as a converted asset. So that cash can be used. But also, if a company issues, for example, trade credits. Now, a trade credit is when you are given additional time to make a payment. So if, for example, a company issues their customer a trade credit, let's say 28 days, when they receive it, it'll be known as a trade receivable. And they are now receiving that cash, which then again can be used to pay off their financial obligations. So anything a company is expected to be converted into cash, for example, within a year, would be known as a current asset. So a fixed asset is still an item. It still can be converted into cash. However, the company is not expected to do so in the near future, and the reason for that is probably because they need it. They need it to operate. So, for example, from looking at the images, you can see maybe machinery, maybe in terms of vehicles like that are used for maybe deliveries or for manufacturing or whatever it might be. If they sold them and they needed them to actually operate, then they would no longer be able to operate. So therefore, they need to keep hold of that. If they were to sell it because they were updating it, that would be different. But a fixed asset is, again, it's an item that if it was like a worst case scenario such as survival and they were really, really struggling to pay off their liabilities, then they might be forced into selling these fixed assets. But otherwise, they will not usually convert them into cash until they really need to. The other image, as you can see, is property. So property, obviously, they need to operate within the property. So again, they wouldn't sell it unless they were maybe expanding, they felt that the building was redundant, so they were going to sell it off, or they were struggling to survive and they were forced to sell it off. Okay, so now we're on liabilities, and liabilities is simply a financial obligation, so the company has to pay it off. They're contracted to do so. And we can break it down. We can break it down into current liabilities, or we can break it down into non-current liabilities. And it's very, very similar theory as to when we're talking about current and non-current or fixed assets. A current liability is short-term. It's expected to be paid very soon. And a non-current liability is that there's no financial obligation straight away, and actually it's accepted that they'll make the payment over time. So when we're looking at a current liability, it could be, for example, short-term loan repayments. It could be the payroll in terms of wages that are expected to be paid to their workers. It could be even when we were talking about trade credits before, if they've received the trade credit, so they were given that trade credit, for example, again, 28 days, then in 28 days, they're expected to pay that back. Now, on a balance sheet, if they've received that trade credit and they have to pay it back, it is known as a trade payable. So, In terms of current liability, what tends to be the case is that the company will use their current assets to pay off their current liabilities. And if the company is able to do that, then they are liquid. But if the company is struggling to do that, then there's liquidity problems. So the non-current liability, as I said before, it's not expected to be paid in full in the short term. They've often got a much longer payback date. So if you think about what a bank issues, such as a mortgage, sometimes you're not expected to pay that back for 20, 30 years. If you consider, for example, a long-term bank loan, again, it might be 5 years, it might be 10 years, but you're not expected to pay it back immediately. Now, the final component is equity. And what equity means within a balance sheet is the amount of funds that have been contributed by either the owners or the shareholders to help fund the business in terms of funding for their assets and buying those assets, but also paying off their liabilities. So as it says here, it refers to the investment into the company. Now, the reason why it's called a balance sheet is because the setting components of what I've just been speaking about, which needs to balance. So what needs to balance is total assets, so your current and your fixed assets, should actually equal your total liabilities, your current and your non-current liabilities, and your total equity. Because obviously, remember, your total equity, it should be helping to fund these total assets, but also pay off these total liabilities. It's kind of like the difference between your total assets and your total liabilities. So what I've put here is a statement. So a balance sheet is a statement of the financial position of a business, and it illustrates the business's net worth. So what we're going to do now is we're going to have a go at calculating a balance sheet, and we're going to do one from scratch. And then I'm going to give you a type of exam question that you might get in GCSE or in level 2, and I'll give you time to practice to calculate it. So in this situation, I've already given you all the assets and all the liabilities as well as the equity. And for your non-current assets, you've got your property, you've got your equipment, you've got your machinery. And for your current assets, you've got your cash in your bank, you've got your trade receivables, and you've got your inventories, also known as stock. For your current liabilities, you've got your trade payables, and you've got short-term loan payments, and you've got payroll. And for your non-current liabilities, you've got tax, which has been deferred. So in other words, you don't have to pay it back straight away. It's been deferred for a later point. You've got pension payments for your staff in the future, and you've got your long-term bank loan repayments. And finally, the company's being funded by retained profit and share capital. So remember, share capital is the money that you receive from selling shares. Now, what I want you to do, I want you to pause the video, and I want you to simply just calculate the totals. So just add them up. Add up your total fixed assets, add up your total current assets, your current liabilities, your non-current liabilities, and your equity. So I'm just going to give you a minute to do so. So you should have got this. All right. So your total assets, you may want to add them up now, but they should be $386,200. If you added up your total current liabilities and your total non-current liabilities, then you should get $114,100. Now, if you, and this is the important bit, and this is why it's called a balance sheet. If you add your total liabilities and your total equity, what you should get is this. And if you don't get that, then there's a mistake in the balance sheet, because they have to balance. Your total equity plus your total liabilities have to equal your total assets, because like I said before, the equity is what funds the assets, which then the assets is what pays off the liabilities. So therefore it has to equal. Now what I want you to do is we're going to look at some formulas now, and we're going to look at the current ratio to begin with. Now the current ratio measures liquidity, and what that means is their ability to pay off their financial obligations in the short term. Now you can already see that their current assets are $22,200, whilst their total current liabilities are $22,600. So therefore at the moment their liquidity is not very good, because they haven't got enough current assets to pay off their current liabilities. But we need to know exactly how many assets they've got when we're considering £1 of liabilities. So how you do this is the following. So as you can see by the formula here, your current assets divided by your current liabilities equals your current ratio. So I'm just going to give you a minute to quickly do this, pause the video, have a go, and tell me what you get. So what you should have got is 22,200 divided by 22,600, and you should have got 0.98. So what that means is for every £1 of liability, so every £1 that they owe, they've only got 98p to fund it. So for every £1, they are 2p short. So where is this 2p going to come from? And that's the issue what this company will have, and they'll have to find a way of doing so. Will it come from their fixed assets? It might do if the current liabilities start adding up and their current assets are not able to handle it. Then they might have to find other ways, or they might have to try to increase their current assets in some way. Or obviously, the other solution is just to reduce your current liabilities. So, for example, if their trade payables are becoming too much, or if maybe the payroll is too high, they might have to think about redundancies. You might have to look at it from that point of view. Right, the next one is it's known in some exam boards as the acid test ratio. In other words, in other exam boards, it's the liquid capital ratio. But what this is pretty much the same as current ratio, but you subtract the inventories. And the reason why you get rid of the inventories is because it's looking at pretty much the worst case scenario of the company. If they didn't have the stock, would they be able to still pay off their assets? I mean, this business, even with their stock, they can't pay off their assets. So there is absolutely zero chance that they will be able to do it without their assets, without the stock, sorry. But let's think about how severe it would be if some of their stock wasn't sold. So as the formula shows, your current assets minus your inventories divided by your current liabilities, and that equals your liquid to capital ratio. So again, can you pause the video and can you quickly have a go at calculating that? So the difference between your current assets and your inventories is 12,200 because you're 22,200 minus 10,000. And then if you divide that by 22,600, which is your current liabilities, you only get 0.54. So they've got 54p for every pound. Now, obviously, the company is expected to sell its stock. So you may argue, well, what's the point in this formula? Because it'd be unrealistic for them not to. But all it's doing is really emphasising that if the company doesn't sell its stock, doesn't sell all of its stock, and there is some stock that goes to waste, then they are even in a worse state in terms of liquidity. They're already bad with the current ratio, but they're in a really bad situation, obviously, with their acid test or the liquid capital ratio. Now, sometimes you might get a current ratio which is positive, so for example, above 1, but then when you work out the liquid capital ratio is really, really below the 1. And therefore, you can use that as an analysis tool to say that if this company didn't sell some of its stock, then actually they wouldn't be liquid. So this is a question that I'd expect you to get in an exam in GCSE or level 2. And what you've got is you've got some of your balance sheet missing. So you've got cash missing, you've got current liabilities missing, and you just have to pretty much work out X and Y. So again, I'm going to see if you can do it. Pause the video, have a go, and then I'll go through the answers and why they are the answers. So, if we're looking for X and we're looking for cash, cash is a current asset. And we already know we've got one current asset, which is a trade receivable of 90. Now, the total current assets that they've given us is 120, as we can see here. So what we need to do is we need to work out if the total current assets is 120, trade receivables are 90, then what is cash to make it up to 120? So by rearranging the formula, so we do obviously 120 minus 90, and that gets us the difference, and that gets us what the cash should be. So that'd be net 30. And what I'd always recommend is go back to the original formula, add them together, your 90 plus your 30, and you should get 120. So the next one is your current liabilities, and we don't know what our current liabilities are. They don't even really give you much information, and there must only be one current liability. But what we do know is the net current assets, and all I mean by the net current assets is a difference between your current assets and your current liabilities. That is 70. So whatever Y is, If you minus that from current assets, you will get 70. So again, have a go and see what you can get. So in this case, you could simply just minus it. You can do 120 minus 70, and that will get you the 50. All right, and if you do go back to the original, 120 minus 70, sorry, 120 minus 50, you will get 70. Now, if it was the other way around and your current assets were missing, and you had your current liabilities and you had your net current assets, then the fact that their net current assets is positive and it's a 70 shows that their current assets must be higher than their current liabilities. So in this case, all you do is your 70 plus your 50, and that would get you the 120. Now, what I want you to do, I want you to work out the liquid capital ratio, and I want you to work out the current ratio. So again, pause the video and have a go. So you should have got 2.4 to 1. So for every £1 of liability, they've got £2.40. So this company is really liquid. They've got more than enough. So that's for the current ratio. In fact, you can't do the liquid capital ratio because you haven't got the inventories involved. But with the £2.40 to the 1, you can tell that they can pay off their current liabilities comfortably.